The most helpful indicators in ranging markets are oscillators, and oscillator values change within a predetermined range, usually 0 to 100. Low values indicate oversold conditions when the market is likely to change direction and go up, and high values are recorded in overbought conditions. In that case, the anticipation would be for a price pullback. Important to note that as other indicators, oscillators are focused in closing prices of candles rather than extreme upper and lower levels. Those prices are more significant and most market participants know it, while extreme levels are often small money of weak individual traders and does not reflect the overall consensus. So if for example we have a candle such as this one, we will usually treat more seriously to its opening and closing prices than to its long upper and lower shadows. Now we will talk about two oscillators which are among the most used ones and learn how you can use them profitably in ranging markets. The first one we will deal with is the RSI or Relative Strength Index. The RSI is a great indicator you should definitely hold as a tool in your arsenal. Its formula looks like this. The calculation is not complicated, but it doesn't really matter for us now, as what we are looking for is the implications. Basically, it simply calculates the average of increasing days in relation to the decreasing ones and generate a value that helps us know the current price behavior in compared to the last period of time that we measure. The horizontal reference area is usually 70 for overbought and 30 for oversold. Some prefer to use 80 and 20 or other setting. I suggest that you play with it a bit and test what are the levels that works best on the specific currency you trade on. But keep it around the levels I mentioned and it should work well. Here are the basic principles of how to trade RSI. Basically, if the line goes up above the 70 line, it means that the price is overbought. This is a zone where you should be looking to sell. And if it goes below 30, we are in an oversold region. This is where you look for buying opportunities. Now we will learn two very useful strategies you can use with the RSI indicator. The first one is classic overbought and oversold strategy. We already know that if the RSI line goes above the 70 line, it means that the price is overbought and we enter the selling zone. If it goes below 30, it's oversold and within a potential buying zone. However, if you want higher probabilities trades, don't use it blindly. Buy when the price is oversold only if the longer term trend is up. And of course the same for selling an overbought level. So if for example the 1 hour chart indicates oversold and when you go to the daily chart you see long-term positive trend, then enter the trade. And the same on the flip side. In other words, only trade this signal if it's compatible with the long-term trend. Another thing is that as we said, you can never know for how long a price would stay in an extreme level. So it's wrong thing to automatically buy and sell in those areas. In order to have a safer trade, you want to first see the RSI crossing back from the extreme level towards the desired direction of the price. You already know how to add the indicator to the chart. The only thing is make sure that the default setting is 14. Let's look at this chart for example. We want to test this trading week from the 24th of March to the end of the month. Assuming we want to take short day trading trades, we will look for entry signals in the 15 minutes and 5 minutes charts. So first thing we want to do is going to a longer term chart and check its direction. So here we are in the hourly chart and we can see a clear downward direction. We already know that we will be looking for overbought signals because they will allow us to sell and trade with the desired direction. So now we will go to the 15 minutes chart and look for overbought signals in the same period of time. Here we can see it was getting close to the extreme level but couldn't reach it. We go on and there is our first overbought indication. We will wait for the line to cross back toward the direction of the price trend, in this case it will be here, and enter a selling order. And bam, look what happens to the price. Worked like a magic. Then on the 28th we have another overbought signal. We wait for it to cross down back and sell. And again it worked perfectly well. And if we would go on with the chart, we will actually not find any more overbought signals at this specific week. But if we want more signals, we can go to the 5 minutes chart. And look how many signals we got here. First we have this point, oversold area, a crossback and a this line. Then again here, after this overbought we have this decrease, and here look at this nice drop after the selling signal. Actually, it continued working almost every time, with at least a certain this line after our overbought selling signals. Now we will talk about the second strategy, which is divergences. Divergences is a bit more advanced use most traders don't even know about, but in practice it provides much better indications than simply reading the values of the oscillator, and there are many techniques based on them. By using divergence, we can see when a movement gets weaker and ready to reverse, and it happens when the behavior of price and the RSI value don't match. Bullish divergence buy signal happens when the price falls to a lower low while the RSI makes a higher low. The signal is even stronger if the second high of the RSI is crossing the 30 line upward. You buy when the price goes up from the second bottom. You need to protect yourself, so in case it doesn't work, you sell back whenever the price drops below the latest price's low. Bearish divergence sell signal. This is the same idea but in the opposite direction. So if an up movement proceeds toward the higher high, while the RSI is performing a lower one, then it's a bearish sign, especially if the lower peak is below the 70 reference line. You sell after the price drops from the second top and protect yourself by buying back in case price goes a bit higher than the previous high. Here is how you could use a bullish divergence for identifying a reversal. At this price low, we can see an oversold level. Then, while the price is dropping to a lower low, the RSI is making a higher low, performing a bullish divergence. Then the line goes up, crossing upwards from the oversold area. After the next low, we see that the price is also starting to rise higher from its bottom, and this is where we want to buy. As you can see, it worked great, and look at the huge reversal and up movements that comes next. Now let's see a case with a bearish divergence. Here we have these overbought highs while the price is going up. Then the price rises further into a higher peak while the RSI is making a lower high and crossing down the oversold reference line. The price then starts dropping, and with the closing of the first red candle we have an opportunity to sell. As you can see in this chart, this bearish divergence signal indeed worked while the price went lower. So now you know what oscillators are, and we learned two basic strategies using one of the most common ones among them, which is the RSI. In the next video, we will learn about another great oscillator and how you can apply it to generate profitable trades.